Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for March 3rd of 2024. Well, we're going to get caught up here after being off for a week. Have a little bit of data to go over here. We have the PCE, Personal Consumption Expenditures Deflator. So this is the Fed's preferred proxy for inflation, if you will. And you can see here in these charts that it actually remains a little bit sticky here. So just as we thought, the heavy lifting on inflation's already been done. And so the effort to get from the current state down to 2% is just going to be inherently more challenging, but it is trending in the right direction. We just know that it's not necessarily a linear process. And also January is kind of a wonky month. You tend to see variances in the data that you don't see. Oftentimes you get a new year, you get adjustments that are made, and so on and so forth. And so not terribly uncommon to see January be a little kind of offbeat, so to speak. But be that as it may, the inflation, as it were, from the PCE was in line with expectations. Here we have a survey at 0.3% on a month-over-month basis. The core PCE was at 0.4%. You can see here that the super core PCE deflator month-over-month, and this is core services inflation ex housing, and this was the one that got everybody's attention. While PCE itself was in line, this super core that it continues to get refined, and it's one of these little measurements that economists have really been kind of hanging their hat on lately. You can see the downward trend as we've been watching here for a number of months, and then this data point right here. So inflation, I think, 1 month does not a trend make, and I'm not going to get overly bent out of shape here. The overall trend is down, but you're going to have months like this, especially January, the first month of the year, where you tend to get some of these anomalies. Got some more PCE information for you here. This is the consumption expenditures ex food and energy. So this is kind of looking at that core once again. You can see here is this trend line is pretty well established before we get to the pandemic, and then the bounce back, and then of course inflation's gone back down. We're looking at about 2.63. Again, overall inflation is coming down. It's just getting a little sticky at this point. It's getting back to where we want it to be over time. It's just not quite there just yet. Here we have core PCE less housing. So this is just taking yet another slice of the pie here, and it's just saying core PCE, which we just looked at, and if you take out housing, right? And so here's this linear trend over many, many years, and then we saw that housing, the PCE overall inflation going up, and then you see that coming back down here. Where we are, if you back out housing, is about 3.5%, and you can see this latest data point being a bit of a surprise. But in the grand scheme, as you're looking at it on a percentage basis, year over year, it's just a little bit of a fishtail here. So nothing to get too bent out of shape about. Here we have from the Department of Commerce a slide depicting personal interest payments relative to personal consumption expenditures. So this is, again, another derivative chart off of the PCE that we've been talking about. And so, this is going to, over time, get some interest on the part of the commentators, because you can see that this number is getting back up into areas that, we haven't seen for decades, really. We've got 3% as a percent of overall PCE, obviously well above where it was, and certainly well, you go back to, basically about 2010, and you can see that number is a lot lower, both in the aggregate and in relative terms. You go from 2 to 2.5% to 3%. From an overall spending standpoint, consumption expenditure standpoint, that's a pretty significant move. Here we have a chart looking at personal savings as a percent of disposable income. We've been monitoring this for some time. We had all of these transfer payments here during the pandemic, which drove personal saving levels higher. Of course, we've been spending that down, fueling consumption. We had a little bit of a uptick here, but now that's trending down. We're now at 3.8% savings rate. The question is, looking at the trend line, we spent many years over the last decade, at a higher level of net savings than we are now. The question is, where does this line of best fit over this near-term data? Where does this go from here? Okay, chart that we have from FactSet is published by Nuveen. We have small cap valuations. Again, we keep talking about this. These small cap valuations are actually pretty attractive. You can see relative to large caps, we're trading at a delta that we haven't seen since way back in 1999 and 2000. Here we have a chart on the leading economic indicators. We got a couple charts here on the LEI. We've been advertising that this has been negative for about 21, 22 months now, which is honestly, as long a period as we've seen in a long time without having a recession. And so, it's just odd that we're not having any recession commentary right now. In fact, the economy's so good that we're actually pushing out expectations for interest rate cuts well into the latter half of this year. But it is a very odd environment. The good news here on the LEI is that it did decline in January. You can see here, but it was at the lowest level of decline that we've seen in almost a year now. Digging a little bit deeper into the LEI, you can see here again, it was down about 3 points, and again, that was the lowest rate of decline that we've seen in quite some time. But really, the non-financial components were the big driver of that. We had all of these components that go into computing the LEI. We had some that were basically mixed to higher, and then we had a few that were a little bit lower, but really non-financial components were the driver here. Look at productivity. We've been talking about productivity quite a bit as a way to higher productivity helps to mitigate inflation. We have certainly seen factor productivity exceed expectations, and it really puzzled a lot of economists, the fact that we've seen such strong productivity. And here is really a depiction of where that's coming from. So we got information technology, professional and business services, basically all of these elements in technology and services. We're seeing a lot of perhaps increased automation, AI, beginning to filter into these numbers. But if you're looking at factor productivity gains continuing well into the future, this is likely where it's coming from, and I do think in many respects it is sustainable. Talk about the housing market for a second. Some data here. We've got existing home sales year-over-year change. You can see that was quite negative not too long ago. Literally about a year ago, we were witnessing a pretty strong collapse coming off a monumental gain. And so now we're kind of getting that, the amplitude is kind of like muting itself out, and I think we're going to kind of meander around the baseline for a little bit. Our year-over-year change in home sales is still negative, but it's only slightly so. So now we take the home sales, the existing home sales, and overlay that with new home sales. So, we just looked at that chart in the amber line that we are basically down around 1.4%. These are existing single-family home sales, still negative, like I said, but not decidedly so. So, that environment's improving. Consequently, we've got new family home sales. And again, that's a less impactful number from an aggregate standpoint. But we do see, all of this meandering, kind of, some positive correlation here. But we do see new home sales, which have actually been pretty positive lately, begin to temper a little bit. And the question is, are they going to kind of trend here towards a flat line? You can see that, this data tends to follow each other, and not necessarily at a lag, but you would expect this kind of deviation to kind of rectify itself, and that both of these are going to meet in the middle somewhere. Here we have existing home sales, 1999 to 2024. You can see the aggregate number here is about 4 million. We've certainly been a lot higher. When we looked at over the last decade, we were running, well into 5 million units. So, obviously that has changed, and, it's a supply and demand problem. And here's an exemplification of how supply is being constrained. Here we have median sales price changes in the housing sector. Now, we have seen a bit of a resurgence here. So again, it wasn't too long ago that we were talking about price declines and how that was going to impact. And a lot of people were, again, running for the exits, trying to get their home sold before prices went down. And, now, just like all good things, I think housing is generally a pretty good inflation hedge. Now, again, this is the global financial crisis, and so we really have to kind of look at that under a microscope in singularity, because this is a huge systemic event, had major dislocations in the pricing market. But absent that type of episode, we're really looking at 5 to 6% a year, and so what we have now is very much in line with the longer term averages, excluding extraneous events. We'll look at government outlays here. This is a chart that should get everyone's attention if you're a voter. Obviously, you go back to 1970, a lot of this was, at that point, it was significant, but in relative terms to today's dollars, not so much. But you can see the geometric rise, and really the shock value in all of this is once you get past this current, the current day juncture, and you look at all of these forecasts, you get to Social Security, a lot of conversation there. Don't think the government is going to let these two entitlement programs go by the wayside. These are kind of like the third rail, so to speak. But it's going to create a real choke point on some of the more discretionary spending items, and obviously net interest, as we are catching up with the Treasury portfolio of outstanding indebtedness. All of that new issuance is coming out at higher interest rates, and this is something that we always knew was going to happen, that you were going to get in aggregate dollars. We're already at basically $1 trillion of net interest annually. We're almost there, and you can see how that's going to go up over time. And so these are significant potential drags on the economy as we look out over the longer term horizon. Now we've got gasoline prices, just as we're talking about inflation being mitigated in a lot of areas, which is absolutely true. But what we have seen here in this chart that is really not going back too far, just a handful of months here, and you can see where we troughed out basically in December, and then had low prices in January. Again, some of this is seasonal because we're not driving that much. Demand is not that high. We're not necessarily in the driving season yet. That usually comes after Memorial Day. But already we're seeing these prices move considerably higher. And so, if you're looking at things to judge whether we're going to have maybe a super soft economy or just a moderate economy, I think this is certainly one that you want to take stock in. It does matter to a lot of people, especially the lower income cohorts, when they're paying $100 for a tank of gas instead of $50. That makes a lot of difference in pocketbooks. So we'll look at personal income here. We've talked about, the wherewithal of the consumer to continue to spend to drive economic growth, being that consumption is 2/3 to 70% of our economy. Here we have a data point that shows over the last month, the January number, the estimate was actually for up 0.4%. We actually got a full percentage point. So you can see the trend line here in personal income, and we did have a spike. And so the fact that inflation, even though we had a tick up maybe an adverse data point in inflation, it's still, the trend line is coming down. And as a result, we still have real wage gains. And so, have personal income number be up 1% in a month is pretty outstanding. Again, you got to go back, to the summer of 2021, the last time we saw something that was greater than this. And then also sliding over to the right, we've got the trend line of personal income. And this backs out transfer receipts. So if we had the government checks that were included in this, you'd see a big spike here, and then that would be tempered. But again, they're X transfer receipts, so we're backing all that stuff out. And then what we get now is to a trend line that looks, kind of like this. And so mute out the impact of the pandemic, and you can see incomes are actually trending pretty much in line, if not slightly better than our longer term trend lines going back to 2016. Again, this data goes back just a few years, but then, looking at the preponderance of data during the interim, this is an outsized data point. And this is something that if you're looking for that soft landing, looking for an economy that's going to be able to land on its feet, this is a slide that should give you comfort in that regard. Looking at the commercial real estate market, we spent a lot of time on this over the last several months. Obviously, office is challenged. We do see the office vacancy rate. This is from Goldman Sachs. You can see, here we've got projected increases in office vacancy. We know that actually here in Texas, because money was cheap and, we have fairly accommodative building zoning codes and what have you, that we built a lot of office, and now Texas has one of the largest vacancy rates in the nation. But this is something has broader implications into investments. When you look at real estate investment trusts for investments that hold a lot of office properties, it has an impact for institutional investors such as insurance companies that have long-term investments in office buildings. We do know from a relative standpoint that, if you, think about, office as a percent of the total commercial real estate investment option, it is fairly low, but is something nevertheless that we're going to have to watch from a credit standpoint in the coming years. The chart here that I thought was extraordinarily interesting. Again, data that goes back to the year 2000. It looks at the total retirement assets that are out there, and it kind of breaks them down by the source. And so back in 2000, we had $2.6 trillion tied up in IRAs. And you can see how IRAs have really blown up, getting back to 2021. Again, this is a pandemic year. But then we've seen less impulse from IRAs here recently than we had, in the prior, 5 months, or excuse me, 4 or 5 years prior to the pandemic. And then we still see a lot of defined contribution plans. These are, 401ks. So we still see those numbers remain fairly steady. And then we've got basically government defined benefit pension plans that are out here, and then annuity reserves on top of that. And then obviously the red is private sector defined benefit plans. But interestingly enough, where we thought that a lot of those plans were being retired, you'd expect that those defined benefit plans would give way to defined contribution, but they've actually held in pretty steady. But when you think about the broader market for retirement assets, they're almost, I'd say a good 65 to 70% of them are going to be in either IRAs or in 401k plans. We have a conference board indicator of consumer confidence in the stock market. So this is a survey asking respondents specifically to, give their assessment of whether they think stocks are going to go up or down. And so, if you have numbers that are down here, then they expect they expect it to go down. If they have numbers above zero, then obviously there's a clear expectation that prices are going to go up. And right now, that exuberance factor is pretty high right now. And you can see that we haven't seen this kind of exuberance in a number of years. But as you'll see over the next few slides, could we be primed for a bit of a pullback here? And I think that's a good rhetorical question. So in looking at the technicals, and again, I spent a lot more time on fundamentals, but technicals do tell a story. And so you've got, here's the pace of the S&P 500. And then this blue line here represents the 200-day moving average, the DMA. And so that's a daily moving average. And so it's meant to kind of smooth out over time daily movements and the S&P 500. Now, the issue is when you get stretched like this and you get a deviation, again, here's the distance above or below the 200-day moving average. And, again, we have been, close to this juncture a couple of times. As you look out, this is 2018 and this is 2021. Obviously we had a correction here and we had a correction here. The question is, are we apt for a bit of a correction here? So we have mutual funds that have really slashed their cash investments, so they're getting invested in the market. They're turning some of that cash into fixed income. And you can see cash and liquid assets in terms of billions, that number is coming down after we saw a couple of years of fairly strong especially as interest rates were going up, we saw a lot of money going into cash. We have the equity sentiment index, just as we've seen in the last few slides. We've got cash that's coming off the sidelines. We've got equity sentiment that's really high. We saw the consumer expectation number being really high. Now this is the equity sentiment coming from more of the institutional market, and those folks are also exuberant. So we've got net long on the S&P 500. There's just a lot of optimism in the equity markets right now. And the rhetorical question, I think it's a fair question, is are they too optimistic for right now? Have they gotten ahead of themselves right now? We will soon see. All right, here we have a chart that kind of gives us some insight into what folks are thinking about earnings. So earnings help to provide that multiple, the price to earnings multiple. And so when you have high earnings, it tends to allow stock values to expand. Now, it wasn't too long ago that people were a lot more despondent on earnings trends, especially into 2024. But clearly, as you see here, where there might be some lower optimism as far as the first quarter, and we're not going to get those reports until about the middle of next month, April. But expect it to be muted in the first quarter, coming off what turned out to be a fairly good reporting season for the fourth quarter, which we just transpired. But then the optimism continues as we get into the first quarter of 2025, so much so that the current estimates are for a year-over-year gain in the first quarter of 25, around 15%. Again, coming off a fairly modest quarter, so year-over-year comparisons are certainly apt to be a little bit more aggressive. But be that as it may, you see this general trend line of optimism. And so as long as you have that, and if this does play out, then I do think stocks have room to grow. But just owing back to that last chart that we showed you with the market being so far ahead of its 200-day moving average, I think if this plays out, the upside trend line is intact. It just may mean that we're due for a little bit of a pullback here. All right, we'll talk about corporate credit for a second. We've been talking about the economy being better than expected. We've talked about earnings maybe being a little bit better than expected, certainly for the fourth quarter, and really for the balance of the last year. That the whole earnings environment is kind of felt a lot better than it probably looked a year ago. But along with that has been confidence in the credit markets. And so we see here that we've got double B rated corporate bond spreads, that are as tight as they've been in really many years. And this is obviously something that you would not see if you felt like you're going into a recession. And even though we've seen an uptick in, like, say, bankruptcies, and we've seen an uptick in credit defaults, it's not been enough to dissuade the confidence that the market has that these bonds will be money good. And when you think about double B rated, I mean, these are bonds that are really at that cusp of being non-investment grade. And so, we look at, high yield. The high yield market, the sub-investment grade market, is a real barometer for the health of the economy, and also the expectations as far as like an economic slowdown go. So we'll continue the conversation about credit quality. So we just showed you that credit spreads are really tight, which is a sign that the market is very confident in the credit quality of those bonds. But there is obviously another story at foot here, and I think at some point we'll probably have a little bit of a reconciliation between these two data points. But we see that we've got more downgrades into junk status, which are triple C's, triple C plus. You can see that has been playing out over a number of quarters. We did see over the last couple quarters that in North America that we've had an uptick, and clearly rest of the world we've had an uptick in downgrades. Now that doesn't mean that they're going to default. It just means that the rating agencies have become a little bit more cautious and careful. So that is something that we watch, though. Right, and then we've got the year-to-date and kind of this trend line data going back to 2008. Again, there's a lot of different embedded data here, but the takeaway is in 2024, particularly in Europe, we've had an increase in defaults. And so, again, if this is habit forming and this number, by the time we're all said and done, looks really outsized relative to the rest of the market, at some point those credit spreads are going to reverse. So we saw in that prior chart, and things are going to go the other way. And again, it's a kind of a tug and pull kind of situation right now, as far as like, is this data going to get inherently worse? Again, this is a lot of this was driven by Europe, to be fair, but global credit spreads are by and large pretty tight right now. And so we just need to monitor the data, again, not to get too carried away with 1 month's worth of data, but nevertheless pay attention. We'll end on a couple of China slides here, something we continue to monitor. Chinese economy is still rather challenged right now. We've got the Manufacturing Purchasing Managers Index. Again, that was pretty much in line, you'd have to say, but it's still negative. And so, we've seen a negative environment out of China for quite some time. This is a brief spike when China had its post-COVID reopening, and then the reality that they didn't vaccinate nearly enough people and had a bunch of COVID resurgence there. So manufacturing is in the doldrums, and that's something that is important to China, and it's something that could keep a lid on overall economic growth for the foreseeable future. Now, when you look out over the Long-term horizon, this is the issue at hand with China. Currently, about 1.4 billion people in China, obviously one of the most populous country in the world outside of India. However, the one-child policy is rearing its ugly head, and we can see the demographics of China really unwinding, almost back to Chairman Mao. This is a pretty serious deal for China, and obviously it's a very insular economy, very protected, government controlled, very authoritative. I'd call it an authoritative democracy, if you will. But this is an issue long term for China, and again, it's not. This isn't. It shouldn't influence your decision on whether to own a Chinese ETF, over the next 6 months. But when you think about the secular trends, this is something you absolutely have to reconcile into the equation. That's all we got for this week. Hope you have a great week, and we will talk to you again soon.